Hello, everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, our Chief Investment Officer. Great to see you, Mark.
Good to see you, Carrie.
Mark, today we're going to focus on the key themes for the fourth quarter. So I thought we'd start off with some of the most notable headlines. There's a lot of discussion on the topic of fiscal policy, much of it very timely to today's update. So first, Congress is negotiating an extension to the October 1st government funding deadline in an effort to raise the debt ceiling. Then there's the $1 trillion infrastructure bill, in addition to the $3.5 trillion social policy and climate change bill, which is focused on investment in education, childcare, healthcare, and climate programs. Both of these bills are also being actively negotiated by Congress. And then at the same time, tax policy adjustments are top of mind for many of the investors as the increased corporate and individual tax rates are being discussed as an offset to the increased spending. As we look to the labor market, the steady progress that we've been making on vaccine distribution has supported increased spending in areas that were the hardest hit by the pandemic, such as travel, entertainment, and hospitality. And while the expanded unemployment benefit of $300 a week will expire in September and unemployment numbers are decreasing, job openings remain higher than the number of unemployed. And then lastly, while we've seen some recent market volatility, expectations remain that the global recovery will continue and that inflation pressures will ease. Now, in addition to these headlines, we all know that coronavirus is still a major factor, stressing our healthcare system and putting great pressure on the global economy. So let me turn it over to you to provide an update on that latest wave of corona and its impact on the market and economic environment.
Yeah, thanks, Carrie. The latest wave that we've seen this summer in coronavirus is in fact cresting. I think that's a positive. But the summer spike definitely delayed a lot of opening and reopening activity and actually pushed down global growth for the third quarter, as we'll see shortly. But that's in the US. What's a positive thing also is that emerging markets are increasing their vaccination levels at a very rapid pace. And this will help to alleviate some of those supply chain disruptions that we saw earlier this summer that sort of pushed up inflation expectations. And this also is positive for growth. The fact is about 10 billion doses of COVID-19 vaccines are available and have been produced so far this year. That's according to BCA research, and that will enable a full recovery. And importantly, this particular trend that we're seeing, it is a spike in cases, but importantly, the increase in new cases has not resulted in the same increase in hospitalizations. This, due to the fact that vaccines perhaps have limited the strength of the virus. And that's a very, very positive thing too for full reopening in 2022.
Thanks, Mark. It's really great to hear that the downward trajectory of COVID cases is occurring for many reasons, in addition to the impact on the global recovery. And now that we've set some context on the environment, why don't you tell us how the markets are reacting to this activity?
Yeah, we'll start with the bond market. The bond market is signaling a continued economic recovery after this particular summer slowdown. And we can see that in the bond yield. The US Treasury is rising again after falling a little bit in the midst of the summer months, if you look at this particular graph here. And that decline in the bond yield was really a hesitancy of the market to say, well, how bad could this COVID spike be? The fact that it's beginning to rise again is a very positive thing for markets. In fact, the bond yields are now above 1.5%. Inflation was a concern earlier this summer as we reopened and demand for goods and services picked up. But the market fortunately, does not expect a significant inflation problem, at least in the near term. And when we look at the 10-year break-even rate, which is really the market's way of saying, well, what is inflation likely to be over the next 10 years? That 2.4% is pretty much in the realm of normalcy. And that's a very good thing also for the markets. It's also worth thinking about this in terms of how we build the bond portfolios. And our portfolios remain short in terms of their emphasis on bonds that have shorter maturities. And that remains appropriate if, in fact, this bond yield continues to rise like we expect it to next year. The other thing I would say is while the bond market sort of has potentially a clear view as to what's going to happen in the near term, equity markets are looking a little bit more defensive. They're looking for some leadership. Third quarter, we saw a shift away from economically sensitive sectors into more stable and defensive areas. And that came after a very strong recovery in cyclical stocks for the first half of the year. That has pushed the S&P 500, which is trading really close to its all-time highs, also close to relatively high multiples. If you look at the earnings multiple on the S&P 500 is 21 times. And that is a pretty high number compared to history. And we're showing a report here from JP Morgan's Guide to the Markets, but 20.1 times earnings, 1.4 times earnings, for the S&P versus 16 average suggests that there's a very significant increase in valuation. And where is that coming from? It's coming from the top 10 stocks. Again, this very concentrated preference for technology stocks, Amazon, Apple, Google, and the rest. They're trading at 30 times earnings. And that in the face of rising bond yields is a risk to particular growth stocks that whose future earnings are really dependent on the valuation of those earnings going forward based on the current bond yield. And the potential bond yield increase is a negative for valuations, particularly for growth companies. And I think that's really where market leadership is trying to find where it should go next. Value was the flavor of the day for the first half of the year. We shifted into defensive and growth. And I think we're going to see a value recovery coming out of this as, again, COVID cases come down and also global growth picks up. And then finally, global growth does depend a lot on emerging markets, in particular China. And we're seeing a lot of negative news coming out of China recently. We're seeing the MSCI China index down almost 15% this year. And that compares to about a flat return for the emerging markets as a whole. And one of the biggest concerns more recently has come from Evergrande, which is a large Chinese property developer with a lot of debt on its balance sheet. And it's been unable to meet its short-term obligations over the last couple of months. And the reason is Evergrande borrowed a lot from investors, banks, suppliers, home buyers to build apartments. And now they're not able to pay that borrowing back. And that's an issue. And that could have repercussions broader than just the property industry in China, and even broader than the Chinese economy. But the Chinese authorities have stepped in to strategically delever that company. And I think that's an important step, and giving the market some comfort that there's going to be a controlled effort to limit the impact of what Evergrande is and could be in the future. Just a quick update. Wescott does not own Evergrande in the portfolio, and it's not in client portfolios, and we remain underweight China in our portfolio strategies. And so while China is a good long-term growth prospect, we want to be thoughtful about that. The Chinese regulatory regime and government regime is becoming a lot more hands-on, and that increases the country risk. So we got to be very thoughtful about how we invest there. We talked about this before, but we're using managers that emphasize quality and shareholder respect and in what they invest in China specifically. So I think those are the big themes that we're seeing in the market. and what we expect to see in the fourth quarter going forward.
Mark, there's so much information to absorb and digest, so thank you for laying out a summary. It's really hard to believe that we're at the end of the third quarter of 2021 and looking ahead at the year end. So why don't you close us out today with a summary of our fourth quarter outlook?
Sure, I think that's important. The year is moving fast. We're almost at the fourth quarter here. And despite all the headlines, we remain committed and positioned as we had through most of this year. And that is to benefit from the current recovery environment despite these recent events. Our tilt toward value, our underweight to largest technology has added value this year. We expect that to continue going forward. Our defensive equity positions in portfolios have held up very nicely during this third quarter, really serving the purpose of defense in an uncertain world. And our bond strategies that are emphasizing higher quality bonds and also bonds that have shorter maturities is really the place you want to be in rising bond yield environments, which we're finding ourselves in today.
Thank you, Mark. As always, great update. If any of our listeners have questions or would like to discuss any of the topics we've covered in our webinar updates, please feel free to reach out to Mark or your advisor. Thank you.